AI's next bottleneck isn't chips, it's power. Fiona Wu from Magellan Investment Partner joins me with a closer look at how to play the AI boom beyond big tech. Fiona, nice to see you.
Lovely to be here.
Why are we focused on power instead of chips?
Because AI isn't just a chip story, it is also a power story too. You can have the best chips in the world, but if you can't get reliable power to a site at scale, you can't run training clusters or build data centers. Power is becoming one of the real bottlenecks in AI. US government-backed research shows data center demand has tripled over the last decade and could even triple or double for the next few years. That's where utilities matters because they are the ones build the network, connect the load, and in some cases add generations. So if you would like another exposure to the structured AI scene, power is an important lens.
So power and utilities, and we don't often use the word utilities in relation to AI. We also, Fiona, often hear that China is in a better position when it comes to this power race, if we can call it that. So are there opportunities in the United States or for US power companies?
Yes, structurally, China does look better position in some ways because of its ownership structure allows fast grid build out and faster coordinations. I'm saying this not just to please my dad, because my dad worked at the state grid in China for his whole career. So, but it helped explain why there's huge opportunities in the US because there are huge catch-up investment ahead. So that's where utility comes in because a tech company don't want to become a power company. They don't want to build network or navigate utility regulations. But utilities are the specialists who can turn a data center announcement into electrons flowing to a site. And the scale is real. A traditional data center is around 20 to 40 megawatt. A training data center could be several hundred megawatts, in some cases 1 or 2 gigawatts. It's not just one building. It starts to feel like you're dropping a small city into the grid. So that could be a once-in-a-generation CapEx cycle for all the utility companies.
So where are you seeing this show up at the company level so far?
So across our universe, we're already seeing a number of utility companies lifting their CapEx spending meaningfully. So for example, Xcel Energy lifted its CapEx by more than 30% in its most recent updates, supported largely by the large load demand, including Google data center in Minnesota. Another good example is Evergy in Midwest, also lifted its CapEx spending by around 25% to meet the rising demand, including data center activities in Kansas and Missouri.
So that all sounds exciting. Real companies making real moves. What are the risks, though?
It's a really good question. So I think one of the biggest risks is affordability. So when the market gets excited about AI story, the household sitting at home is asked a much simpler question: is my power bill going up again? So utility can have a fantastic growth opportunities, but if the household bill rising too high, it could create political and regulatory pressure. But that matters because utility return ultimately depends on regulatory supports. And that matters even more because of the household bills has been rising in the past several years due to inflation, energy cost, and extreme weather events. And the low-income households are most exposed. And the timing matters too. This year is a midterm election, and there are governor elections in 36 states. So election can amplify the focus of affordability. But that said, the risk is not uniform. In a tighter power market such as Pennsylvania, Maryland, or part of the Northeast, affordability tend to be a sensitive topic. But in some of the Midwestern states, such as Iowa, it is generally less of a pressure point.
You mentioned those gubernatorial elections. So electing a governor, I think in 36 states, which is incredible. So tell us, how could that potentially impact utilities?
So governors actually don't set up the utility rates directly, but they do appoint commissioners. So commissioners are the regulators for utilities. And the governor more broadly shapes the political tones. As the election getting close, affordability tend to be a much lower issue. We're already seeing noise around power bills pressure and more scrutiny over whether data centers are genuinely benefiting local community or they're just shifting the cost to residentials. That said, affordability cannot look on its own. If a region underinvests and the reliability starts to slip, the regulators are more willing to support a higher investment because at that point, the focus shifts to keeping the lights on. So reliability still matters enormously. It's not, so for the story, it's not only a growth story, it is a balancing act among affordability, reliability, and growth.
Do you think, though, that households could end up paying for this power boom that's needed to fuel data centers?
I think this is one of the biggest misconceptions in this debate. If a tariff are designed properly, the large load user can actually benefiting other customers because those large load customers can absorb meaningful share of the fixed system cost and improve the network utilization. The simplest way to think of this is if a large user paying more into the system, all the fixed costs don't have to sit with all the households. A good company example is Dominion Energy in Virginia. It serves the largest data center market in the world. The residential bills have averaged 9% below national average, and the data center load was growing like 20% for the last 10 years. Another good company example is Magellan Energy in Iowa and Wisconsin. The customer bills actually going backwards because data centers are helping reducing those customer bills. Then another thing I want to highlight is I've seen lots of utilities now proposing large load tariff, which to make sure the residential are not subsidizing the large data center expansions.
So you're seeing this better tariff design and stronger customer protections. Is that across the board, or where is that?
There's where jurisdiction matters. We have been identifying jurisdiction with constructive tariff design and stronger customer protection. The names like WEC Energy in Wisconsin, CMS Energy in Michigan, and Average I mentioned earlier in Missouri and Kansas. The features we're looking at are such as upfront cash payments, the length of the take-or-pay contracts, the minimum load guarantee, and exact fees. So this is very important because it helps to reduce the risk for residential customer to subsidize all the speculative build-out.
So what you're saying, Fiona, then, is that utilities, probably one of the least sexy sectors, is actually a way that you can play the whole AI theme.
So investing in AI is largely bet on the innovation market share and executions. The upside could be significant, but the earning path is normally a lot more volatile. Utilities offers a different value proposition. They are not building the AI, they are enabling the physical system behind it. So that can be attractive because the earnings are more stable and more predictable and less driven by who wins the next product cycle, are more driven by the regulated investment and the return framework around it. If AI turns out to be a bubble, those companies are still allowed to earn a return on investment capitals as the way it regulates. So you are not exposed to meaningful downside risk. In a way, utility won't be a flash part of the story, AI story, but it could be the most durable ones.
Fiona Wu, Magellan Investment Partners, thank you so much.
Glad to be here. Thank you.